What is going on, Hot Take Nation? It is DRW, David Ramson Wood, here for another episode of Hot Take of the Day, the podcast edition. Today we have Josh Young joining us, and we're going to cover a lot of things on the how to make money in oil and gas, and which is hard, needless to say, and just sort of let the conversation go where that goes. So Josh, welcome to the show. How are you doing today?
Great. I'm doing okay. How are you?
I'm doing pretty good. What's how have you been keeping yourself busy for the last sort of 6 weeks of house arrest?
So I guess some people have had kind of a calming experience where they've gotten to, explore new hobbies and, take some quiet time. And that has not been the case in the public oil and gas equity markets. And so been quite busy trying to figure out how to lose less money and where I guess the puck is going, what businesses might survive, and then how to get into them in a way that's economic and can make back some of the losses associated with this price war and demand shock.
So a lot of really great stuff to unpack there. So let's start with what is your mandate? What is your day-to-day job that makes you have to look to oil and gas public equities to make money? Because most people would say the best way to make a little money in oil and gas is to start with a lot. And that over the last certainly 2 or 3 years for most public company investors has been the go-to move. Like the shorts have been having a heyday. So talk about your mandate, your day job, and what you're thinking about public companies in oil and gas post March 7th and post COVID.
That's a great question, and also a lot there. So I started investing professionally in oil and gas companies in 2007. And at the time I was working for a multi-billion-dollar single-family office in Los Angeles with a general kind of value investment mandate, an idea to invest in some of the best ideas that we were getting from managers we had allocated to, as well as just opportunistically finding things that were mispriced in some substantial way, whether because they were unpopular or because people couldn't understand embedded or hidden value. And so I've been doing this for a while and have essentially had a number of it's kind of weird for in a 13-year period to have experienced quite as many crashes and downturns. The equity market crashing broadly was very scary to people, I think, in middle of March. But for me, unfortunately, it was kind of just one of many experiences. So I guess I always think about the sector in terms of how crazy and bipolar it can get from, let's say, 2007 to 2010, where you had in 2007 people thinking, oh, hey, this China story is kind of over, overall value going up, China peaking, and people starting to get really short oil, short natural gas, companies starting to hedge, and then getting into that 2008 environment where there was capitulation on the short side and kind of this crazy move in both the physical commodities as well as in the equities. Bipolar market where over a 12-month period, you had people basically decide that we were running out of oil and that this was a disaster and oil was going to the moon, and then that we had too much oil and oil was going to zero. And so if that sounds familiar, that's kind of where I started professionally. So to me, this is, another kind of crazy moment.
Well, and it's interesting that you talk about that, because a lot of the things I've said historically over my career is that the energy industry really started again in 2005. And so you do have a lot of field hands or managers at companies, certainly in the early 2000s, that had been in since the 80s. And the last similar crash to today, even though it's nothing actually similar, but like 85, and people said, oh, I've experienced that. But with the shale revolution and horizontal wells in particular, when you start your career in that, and that's all you've ever seen in terms of, certainly some gaps were reservoir engineering. And I think that generally people who have been short the last 2 years have been around the fact that we've been drilling wells too tight. We've not understood the reservoir quite to the level of the parameters, and we've relied on a subsidized oil price from OPEC. But you kind of came in the industry just as horizontal oil drilling happened, and you saw the mania to 2014, saw the downdraft, and then where we're at today. So I guess a relevant question for valuations: how do you think about valuing a company today publicly to find out, is it a good buy? Because I would say at $30, if that's what you believe, everything's worth zero, including Exxon. And if oil goes back to 60, I think Goldman Sachs had a Brent call. Q1 2021, they think Brent is 60 or 65, which then means that everything that was valued the way it was in February kind of comes back. How do you break all that apart?
So first of all, my crystal ball is fully broken.
Mine
The
too.
joke about predicting is that it's about the future. So there's some serious problems with those sorts of predictions. And frankly, as a trade, anything that that particular investment bank says publicly, especially in a commodity call, generally just take the opposite side of that, because generally if you look at their financial statements and their commentary versus what their sell side analysts say when they get in the news, they almost always conveniently have a proprietary position that is inverse of what shows up in the news. So, are they trading against their clients? Are they, doing stuff independently? And it just so happens that their analysts end up in the news at points where their views are consensus, and therefore it's a good time to trade against. Hard to tell. Obviously, not alleging any sort of improper behavior, but I would just watch out for that sort of thing.
So does that scare? I mean, does that scare you? Because again, and I am, I'm a cynic by nature. That's how the hot take of the day was born. Is that I don't believe most of the public commentary people say. But in every industry, yeah, you have these people go on the news, and you either have. I mean, I had a call from a major network who told me what the story was. They wanted me to give a quote that matched the story they were already writing. And when I said, no, that's not even a story. That's in fact the exact opposite. It like killed their story, so it never appeared. But they weren't calling to be like, hey, what do you think? How does this go? I want to feature like a narrative that you haven't pre-described. It's like, we have a narrative. We need to plug and play. Oil's going to 60. That sounds like a great deal. Here comes a research report. I mean, how do you think that, like, does the market feel fair to you if that's something that happens?
So I need to get some notes from you, because the opposite happens with me. So reporters talk to me all the time. They're really interested in my thoughts. And then it'll show up quoted as from some major investment bank analyst or some other stuff. So I still haven't quite figured out like what it takes for them to like want to quote me, even when they like literally plagiarize or paraphrase my ideas. And then like, I mean, in some cases it's stuff that I hear at conferences that no one else notices. And then it shows up as a, front page article in a, major newspaper or a major whatever. So we need to talk a little bit about that side of things, because apparently I'm doing something materially wrong to not get quoted when they take the ideas. But yeah, I think there's kind of a very clear agenda from a news editor perspective. And I try to not get too far down the road from a conspiracy theory perspective, but, and that's always a dangerous thing to say, I just watched Planet of the Humans, and I think and it's crazy for me to cite anything about Michael Moore, because like generally speaking, our first principles are probably pretty different. I'm pretty libertarian. I'm an economist trained at the University of Chicago. I'm a capitalist, and he's, I guess, none of those things by a lot. But I think he observed that there are some really severe conflicts of interest by people that own the major newspapers and own the major media outlets and so on. And so there is kind of a narrative, and I think you see it in stuff like what you were just saying. So I think there's like, it's in investing we call it, or in other sorts of like scientific stuff we call it like selection bias, but it's not exactly selection bias, because it's not like they have an idea that they think is right. There's an agenda to some extent, and there are strong economic ties between the owners of the media that are reporting these things and the things that they own besides media, which is frankly money losing. So Michael Moore, sorry, go ahead.
No. I mean, you're totally right. Like, this could turn into a Joe Rogan podcast where it's like just 3 hours of diving into that, because I agree that movie is very interesting, and the reaction of the left to that. Like when Gasland came out and the oil industry is like, that's such a misrepresentation of what's going on in the facts. The left are like, that's just their talking points and blah, blah, blah. But then like he has real interviews of real people saying things. And to your point, there are agendas, and the agenda is always about money. So like the green movement is about, I want to build windmills and solar panels, which I control all the control of so that I can make money. I want to shout down natural gas because I own wood foresting and all that. So it is interesting. And there's another movie that's a little conspiracy that's called Out of Shadows, and it's about Hollywood and sort of ties to Jeffrey Epstein. It's a little bit on the kooky side for me if I'm being totally transparent, but it was very eye-opening as a point of view. And I wish people would just like take each of these data points as a point of view, as opposed to like, now I know everything about that topic, so I'm just going to take 100% of it. You should watch it, consume it, make an opinion, and move on. But on that topic, before we dive into conspiracy, how do you personally value a public oil and gas company today, knowing what you know about demand destruction, storage, rebound, post-COVID demand, the green movement, natural gas, and all of the interplays? How the hell do you even try and value one of these things?
Okay, so it requires a little bit more background, and like you said, there's a lot of different things to talk about associated with a number of things we've already mentioned. But basically, my thesis, based on a number of years of investing in different companies, in some cases successfully, in some cases not, owning companies, like I became chairman of the board of a company. I did an activist campaign, less letter writing like you were doing, and more actually like joining the board, replacing management team, selling assets and selling a company. My observation is that there's too little long-term oriented investment in oil and gas, which sounds weird, right? Because there's been giant investment and it's mostly been malinvestment, and too much short cycle investment, first by private equity-backed companies and public independents. And now, to some extent, the oil majors have been like, hold my beer, like this looks fun, and are losing giant amounts of money doing the same kind of short cycle, very aggressive money losing kind of poor activity. And ironically, they're doing it way worse than like you guys did when you were doing that as a private company. Big companies have big bureaucracies and so on. And so my take is that in the long run, because there's been so much malinvestment and underinvestment in long cycle oil and gas, oil prices need to be much higher in the longer term in order to incentivize longer term investment in exploration and development to be able to have sustainable low decline oil reserves that replace a lot of the reserve depletion that's happened over the last decade. So I guess just generally speaking, longer term, I'm very bullish on oil. And I know that would never make it into a news thing like you were saying, because no one wants to hear, one, that you're bullish on oil long term. Two, right, who cares about the long term, right? And the long term is made of a bunch of short terms, which are like 24-hour news cycles, and then multi-month like book cycles or blog cycles or whatever. But in the long term, I think oil is very valuable. And so what I've done is observing kind of malinvestment and observing kind of problematic behavior by companies. I've found companies that generally have lower than average decline rates. Generally, they're on the smaller side because they're the bigger companies were the very well capitalized, very large debt, shale drillers, but some of the smaller public companies own conventional assets with long-lived reservoirs. And today, I can buy those reservoirs for pennies on the dollar. Again, subject to an assumption that over the long run, oil reverts to its marginal cost of supply, which historically it's done over long cycles. And so that's generally how I'm approaching things. So I'm trying to own things that are going to survive, that have relatively low decline rates, with management teams that own a lot of stock, that are incentivized the right way, and where essentially these assets, as oil revalues over time and as money shifts back towards conventional exploration and away from this kind of short cycle capital destruction, those sorts of assets, so water flooded conventional assets, tertiary recovery conventional assets, in some cases just kind of standard conventional, just low decline, latent life assets, those things should be worth a lot of money over time. And that's kind of my core portfolio bias is towards companies like that.
So couple I guess I don't even want to call them challenges because I mean I agree. So at the very core, I agree with your primary thesis, which is oil in a normal demand world, whatever normal demand is, commodities should price at the marginal barrel, and 20, 30, 10, 8, whatever the numbers are totally delinked to the actual replacement value. And a lot of these foreign countries are highly, highly, highly dependent on oil revenue. And without that revenue, the political instability in those governments will be such that you could have much, much more frequent supply disruptions, which again, all biases towards a higher price. I think that's reasonable. And I think most people would say that. Now, in terms of the companies, though, when people say, oh, we need to move back to conventional, the point that I have always made, even long before this, was the U.S. has been in decline since 1973. There was a little pop leading into 1985, 86, where we sort of had a flat incline. But then, going to the start of my career in 2000 and then everything through to 2020, until 2008, the U.S. was in a fundamental decline because all of the low decline conventional assets were exhausted. And more to that point is their costs, their F&D costs and their operating costs were 18, 20, 22. They're very hard to replace, very hard to manage. And so the only, I guess, challenge to your thesis with all that said is, don't you think that there is better conventional oil targets internationally? Now that we've seen the burst, like shale only existed because in a $40, $50, $60 world, that was the best the U.S. had. But to get into the water floods and the tertiary floods and the CO2, don't you need 70 or 80 or 90 to make it work? And isn't there a whole bunch of $50 and $40 a barrel oil in Colombia, Argentina, Brazil, Norway, Saudi, Iran, Iraq, Libya, Venezuela, et cetera, et cetera?
That's a great question, great series of questions. So first of all, having watched shale companies since essentially their emergence in the early 2000s, both personally investing and then professionally starting in 2007, I think I'll copy David Einhorn, who hasn't been right about a lot in oil and gas, but was right about this. There are no profits for shale oil and gas businesses anywhere close to not just current oil prices, but even what we saw in January. So I guess the first pushback would be that those businesses actually lose huge amounts of money, and the development and the capital investment, I think, was malinvestment funded by several different bubbles happening concurrently. So you have a public equity bubble combined with an interest rate bubble where interest rates fell to almost zero, so you could essentially hide rapid or massive money losing activity, along with a private equity bubble where there's been this almost like stampede of institutional allocators to private assets where they can mark to model and not worry about price volatility. And I mean, we're seeing it right now. If you look at the end of year valuations for the private equity funds, just in oil and gas, I mean, you look at them, some of them have these public entities, so you can actually look through them, they're published, and it's bizarro land, right? It's completely disconnected to public marks. It's disconnected to transaction multiples, and so on. So I think it took multiple bubbles concurrently to get the sort of activity at the price levels that we experienced over the last 5 years. And so I guess I don't think that unconventional is any better per se economically than conventional in the US, Canada, offshore Gulf of Mexico. And then from a US versus international, I don't think, other than a few places where there's been severely restricted activity due to political considerations. So whether it's Venezuela, where they tried this socialist experiment that one could argue various countries now are engaging in, and failed, and saw massive declines because of underinvestment in maintenance capex, or whether it's countries that are in OPEC that arguably may not have capitalized their assets as aggressively as they could have. Although I'd actually push back on that and argue that it'd be extremely difficult to economically sustain much higher production in most of those countries that you mentioned than you're seeing right now, even at higher oil prices than some of the prices that we've talked about.
And why would you say that, just out of curiosity, just because their marginal cost of replacement is so high, or because the rule of law doesn't really exist and so there's no capital to invest reasonably, or why would you say that? I'm just curious.
Both. So like, look at Saudi Arabia, right? They've had a giant number of very expensive offshore rigs running for a number of years. If you look at the Ensco-Rowan merger documents, which, now it's Valaris and it's probably going bankrupt. I think they already hired restructuring advisors and so on. But like, if you look at Rowan, which I think they had a 50-50 JV or something with Saudi Aramco or some other Saudi-owned entity, and you look at the activity and the types of things they were doing, those things are not consistent with the F&D costs or the LOE that's commonly, it's always hard to tell in these news articles because whether it's $2 or $10 or whatever, you can't tell if it's like, which part of the cost structure they're talking about. But it's somewhat obvious given what the total, the full cycle cost looks like when you use a $500,000 a day. Not that these things cost that much anymore, but they have these long contracts where it's that expensive. If you use a $500,000 a day drill ship and you have to do all kinds of offshore tie-ins and other sorts of things like that, and if you're running like 30 of them or 20 of them, I don't remember the exact number, but it's like a lot that they were running, there's no way that it's a $2 F&D cost. And there's no way that they're producing oil for less than $10 a barrel. So if you look at all the rigs that they're running and you look at all the activities that are going on and you look at what those things cost in other similar kind of geologic environments, forget like rule of law, forget whatever, just like what's it cost to do this? And maybe there's some adjustments down because they do use some ultra low cost, we'll call it, labor from other countries, as well as very ultra high cost expat work, which probably balances itself out to some extent. I just don't think there's anywhere close to as low costs in OPEC countries as are represented, at least in Saudi. And then if you look at what that means that there's probably not any better economics for offshore Saudi Arabia or Kuwait or whatever than offshore Gulf of Mexico or other places that we're kind of more familiar with and can get exposure to in a US or Canadian stock market.
So I want to summarize and I love the people who have listened to my podcast and have worked with me, more importantly, know that I love these conversations because they go at such a massive pace, cover all the different topics. So I want to just summarize our first kind of 20-minute conversation, which I think is about the core investment thesis that you're operating on is that the marginal cost of a barrel in the world is substantially higher than where it is now and biases more to a 50 to 60-ish world. And so that's position number one. Position number two is the unconventionals were inflated because they used a series of debt bubbles, equity bubbles, and capital allocation bubbles to manifest themselves as the right cost of supply between $40 and $60. But at the core, it wasn't a profitable business. And so that when investment goes back into oil and gas, that will be lesser allocated because of those factors. And there will be allocation to other parts of the business. And your view is the other parts of the business will be a little bit heavier on the exploration. They'll be heavier on water flood, tertiary, etc. And that because of the lack of low-cost barrels in the other parts of the world, it will bias that American companies will continue to invest in the U.S. rather than go international to find the same supply. How did I do as a summary?
I'd say I agree with most of that. I don't know exactly where companies will go in terms of future activity. And I guess I was not really trying to predict where the next barrel of oil will be discovered or what it will look like exactly, incremental to kind of current discovered reserves and resource and so on. That's hard, right? And like figuring out what the next new project will be is, it's a difficult endeavor. I don't really invest that much in service companies, partly because of that, because it's hard to guess like which part of the value chain is going to get stressed. I will occasionally where there's like deep value or something available for pennies on the dollar versus replacement cost, but I try to not make bets on kind of where activity will be. And I guess maybe that gets to kind of more of my investment approach and philosophy, which is that I'm not really that excited about investing in the next new thing. I'm much more excited about buying the last thing for a giant discount to what it would cost to replace it. So I guess I'm less worried about what will, hot oil and gas company of the day, whether it's a Pioneer or EOG or whatever, like what trend will they jump on next to try to attract low cost equity or whatever. That matters less to me because it's just so hard to predict and it's hard to know who's going to win. But it's a lot easier to find a 20,000 barrel a day, water flooded oil producer producing out of conventional reservoirs that should produce for decades, where every year there's been a step up in reserves because the reserves that get depleted get replaced by 2P, get replaced by additional small levels of activity and so on. And buying that for a fraction of what it would cost to create it, whether in the US or Oman or wherever, is a more productive endeavor for me, I think, and seems less likely to generate massive long-term permanent capital destruction, unlike kind of the overall industry. So I think for me, it's always like, there were a couple different times where I've looked at take privates or other things of just public passive investments that I've done. And I've met with different private equity funds and allocators, and they're always like, hey, what's the cost per barrel? And so we talk about like what it costs to produce. And they're like, no, what's like the drilling cost? And it's like, well, I'm not that interested in that because I observe like trillions of dollars getting spent over the last 10 years and almost all of it was lost. I'd way rather go buy the stuff that's already like been malinvested and buy it for a huge discount than worry about how to make activity more economic. And I think that's a big difference in between what I do and what you used to do in a private equity backed private company. You were always looking at kind of deploying incremental capital, and I'm looking at to some extent as a vulture capitalist or whatever, coming in and buying things that the market's given up on at a large discount to what I think it costs to replace those things, partly because I observe so much destruction as capital is deployed, and a view that I think over time, it's going to be more and more expensive for oil companies for a variety of reasons to get capital to deploy it, and that should force the price of oil up and the value of reserves up even more.
So what's really interesting to me, and again, I think that there's so much that we get to have hindsight, right? We've both done this for a very long time. Certainly in investment days, I always said that investment bankers who were like 5 years in were like 60-year-olds because they worked like 24 hours a day, 7 days a week, and so they work a lot of hours into a very short time period. But we talk so much about the oil and gas business, and the word that you keep saying is value destruction, investment destruction, never profitable. And the interesting thing, at least as I think about it, right, is from 2008 to 2014, as oil was rising because of the shortage that was projected in the world, and as companies were seeing $100, $120, $140 a barrel, they were wildly profitable. And then there was a systemic change, and we can talk about all of the reasons why it changed. But OPEC opens the taps, we reduce production or increase production, reduce cost. Then we have a $30 world that manifests itself as a $50 world since 2016. And then, debt was high. There's a lot of structural issues that you and I both would acknowledge from 2016 to 20. But the industry was starting to have a little bit more return to free cash flow, pay dividends, buy back stock, maybe not growth for growth's sake, still a little aggressive, but they'd sort of managed to deal with a $50 world. And then COVID happens, Russia happens, Saudi happens, and now we're looking at an entirely changed world. And so in the 10 years, there's been three discrete investment worlds. And so I would compare it most similarly to the tech bubble of 2000, which all this money was chasing these phenomenal, you register a domain like pets.com and you go get $100 million, and then within 2 months it's gone. And but to blame a management team or investors for trying to catch the wave and then getting caught holding the bag is two kind of different scenarios. Do you agree with that as a general premise around the judgment on oil and gas and the negativity around in the investment climate?
Kind of. So I think that we inappropriately laud winners and we inappropriately trash losers. or I think as a society, I think we focus too much on the outcome and not enough on the process. My observations were not based on outcomes; they were based on process. It's easier now to talk about these things because of some of the outcomes, but many of these things were apparent, not always, but many of them were apparent based on process. So I'll pick on one particular company that's been in the news a lot and on Twitter a lot and other places because their equity valuation is so far in excess of their reorg equity plan, but Whiting, right? So I was an early investor in Northern Oil and Gas in the Bakken because I saw that Bakken well productivity was increasing a lot, and you didn't have to drill very many Bakken wells at $100 oil to earn a huge profit based on 2009 type drilling and completion costs. And so I was an investor in Northern, and I looked closely into Whiting at the time, which was a very different company. This was before they merged with Kodiak. This was before a number of different things. They hadn't quite levered up quite as crazily. And Whiting in 2009, in order to survive, sold a gas plant and some royalties and non-op interest to a entity held by George Kaiser, the Bank of Oklahoma owner, or I guess manager and kind of founder and so on. And they did it in a deal that was absurd. It was so obviously a transfer of shareholder wealth from Whiting to Bank of Oklahoma and to George Kaiser. And it was something where they wouldn't talk to you. If you tried to talk to IR about it, they wouldn't talk to you. I ran into their COO or something at NAPE in 2009 and tried to ask him about it. And he basically said, get out of my booth, go away. And I wasn't short the stock. I was just trying to learn more about the transaction. And you could tell that there were cultural problems and fundamental problems with the business. I don't know whether there was some side deal that happened there. I don't know whether they were about to go bankrupt and therefore they did that transfer of assets or whatever for 10 cents on the dollar. But there was a severe cultural and behavioral set of problems with that entity 10 years before they, filed for bankruptcy, 11 years before. So I push on that.
And you know what? And I totally agree with you because, as you know, from probably haven't seen my hot takes for the last 18 months, I would certainly argue that I was an unconventional oil and gas insider. So in 2014, when the Kodiak Whiting merger happened, I gave a presentation. Oil was 100. I gave a presentation in Denver to a room of 50 engineers. And I said, this merger is the evidence of the death of the Bakken because it's a zero premium merger, all equity with no other buyer. And that they're going to use this price fall, which at the time I thought might go to 75, not to 30. They're going to use this price fall to reduce rigs in the Bakken because they're over drilling, spacing is wrong, we're mischaracterizing the asset for a whole bunch of bad reasons, and get the hell out of the Bakken. And everyone thought I was crazy. A year later, I didn't look so crazy. It obviously happened in 2018 when I was saying, shut down rigs, stop growing production, get the balance sheets in order, manage, merge, consolidate, do all the things. And oil and gas managers have just not been very good because they're very reactive. And as I've reflected on my 20-year career, what I've come away with is because we're so dependent on price. We think we're running a business, but we're just a commodity business. So we don't give farmers who run pigs, we don't give them all these accolades and time on CNBC and proclaim how smart they are because they produce pigs, they euthanize pigs when prices are too low, and they mate more pigs when prices are too high. We are a commodity business 100% at the mercy of what the world does. And I think we've given people too much credit for being super smart. What do you think about that?
Yeah, again, I think we give people too much credit for being smart when we see a good outcome, and we give them too much detriment and we're too negative when we see a bad outcome. And again, that's why I went back to this 2009 transaction for Whiting to talk about it and why I avoided them. And again, I didn't avoid other things that were mistakes, and I've definitely lost a lot of money on things over time in oil and gas, as well as having made money in other things in oil and gas. And so it's not possible to avoid everything, but I don't think the right approach is to judge things based on success or failure. I think the right approach is to judge processes. And again, I just want to push back a little bit on what you're saying. I don't think it's about where the capital goes next. And I think like there's been way too much of an impetus on capital investment in a very capital intensive business, and way too little, in my opinion, focus on the allocation of that capital and the kind of positioning of it, where you look at like a Pioneer, for example, a lot of their assets in the Permian, they got, I think, from way back from some oil majors, I think like a Parker.
And they were old vertical wells. Concho, the same thing. They were in the Permian
Right.
when, if you were in the Permian, it was like the worst asset to ever own. And then the world changed in 2013, 14, and you look brilliant. But it wasn't like they actively took that position,
Well,
is your point.
they did actively take a position where they observed oil majors losing money in a field, and they essentially took the fields, not quite for free, but they got them at very attractive prices, even just based on the value of the conventional production and the conventional development opportunities associated with the assets, just by lowering the overhead and just changing the way that these assets were operated versus how they were operated by the majors. So I think there's kind of two ways to look at it. One is like, what's the hot next thing? And the other is, okay, so you have these assets, they're peaked. And one could argue that a number of the shale oil assets and the shale gas assets have also kind of hit maturity to some extent too. So once you're there, then the question is, I think, how do you think about those assets? Who should manage them? What should that cost structure look like? And, if you can, like T-Boone, he noticed in the 80s, if you can go buy oil barrels on Wall Street for cheaper than drilling them, or if you can go buy them by buying an asset rather than by drilling an asset, I think it's really important to think about doing that. And I would observe that we're still kind of in this shale bubble, right? If you look at the valuations of an EOG or a Concho or a Pioneer, I mean, these guys still have giant valuations that are highly dependent on them deploying many rigs, drilling wells that over a 10-year period, and I'd push back. These guys weren't actually earning real profits in 2014 either. There weren't, if you look at kind of the fully depreciated costs on their capital and so on, like this wasn't a highly profitable business even at higher oil prices. But if you look at their capital allocation on a 10-year basis, it's abysmal, just like almost the rest of the industry. And so I think there's still room. I don't know whether it'll fully deflate, but I think there's still room for kind of this boom to bust further. But from a capital deployment perspective, I think there's room to come in and pick off stuff that's too cheap. And I do think the cost of capital for deployment into oil and gas capital investment into drilling and so on will just keep rising. It should over time. And as that cost goes up, the cost for oil should go up and the value of existing producing assets should rise as well. So again, I think I see it a little bit differently.
Yeah, no, I mean, and I think, and again, I think that this is a great conversation. Hopefully listeners see, because there's so much nuance, right? You have an investment professional and a technical professional who are having a conversation around, what is the true profitability of it, and what's the nuance, and were they making money, and how much did price overlay, and how much was willful choice versus outcome versus process. And we're not going to dive into this, but then we see a 20-second clip on television of Dr. Fauci saying, we better shut down society or everyone dies. And then that's the thing we do when anyone would be able to have a nuanced conversation about any topic. And it's very hard to play like how much gray area there is. Now, if we take a step back from energy, because I think that the points you're making, when I look at Amazon, when I look at Apple, and I'm going to use Tesla, when I look at those companies, they feel a lot like oil companies in 2009, and they feel a lot like the valuations of tech companies in 1999, where you have a whole bunch of LP and pension capital and hedge fund managers who are making trend bets, and they're pushing valuations up or dropping valuations, and they make absolutely zero sense in the world. And so let's take Tesla. I think Q4 they were going to sell 110,000 cars. They're the biggest market cap company of all of the market caps of every car company combined. In the most recent quarter, where they announced, I think yesterday, And Einhorn, to mention Einhorn, he talked about they had like $240 million of like revenue from sales, and they had $350 million of revenue from these carbon credits that people are forced to buy to offset the CO2 creation of a conventional vehicle. So that Tesla is inherently being subsidized for this future EV world that Michael Moore is mentioning. Maybe that doesn't make sense, and people freak out. And then the most important point of all of it is they don't make profit either. And so how do you compare the where we're at in energy right now, that when busts happen, people look at the business model and they're like, who has $100,000 to go buy a Tesla in a recession? No one's going to buy any more cars. That car should be worth zero. And yet Tesla's wealth creation has been infinite relative to Exxon, Chevron, blah, blah, blah.
I mean, there's a lot of great points in there. I think two specific things. And then I do want to talk for a minute about a couple of like places where I think there is actually opportunity in kind of the oil and gas value chain.
Mm-hmm.
That I think you might find interesting as well. But first of all, on the Amazon, kind of the Amazon, Microsoft, Google, this whole cloud thing, it's fascinating because if you look at the accounting on cloud computing and software as a service and so on, but specifically on the infrastructure associated with it, it's almost exactly like shale. So Moore's law says that processing power doubles every 18 months and falls in cost by 50% over that same time frame. So if you think about that versus a decline curve for a shale well, it's actually quite similar. If you look at their balance sheets and you look at how their income statements, you look at how they're depreciating this stuff, it's the same problem or a similar problem to how, let's pick on EOG, right? As a company that hasn't people haven't they trash it kind of sometimes, but like EOG, like never really changed their accounting approach when they spun off from their prior corporate entity. And, if you look at like where they spend their money and like kind of how they book stuff versus like an Amazon, where Amazon is building these giant data warehouses and they're building these giant computer centers, and they're straight line depreciating the things, even though there's this law that everyone acknowledges. I mean, this is basically like, essentially, I mean, it's not quite science, but it's like pretty close. Like you ask a computer engineer, you ask a software engineer, hey, what do you think about Moore's law? They say, yeah, like that's good. So it takes like 2 minutes looking at the financials to say, hey, wait a second, what business are you in? How are you valuing this? Like, how can this make any sense? So even whatever meager earnings they show are still based on a fallacy kind of similar to how shale and other oil and gas businesses have gotten valued as well.
And that is, I mean, again, my issue with the whole markets is they go up 0.25% a day for 10,000 days and then they correct 50%, because at the end of the day, exactly what you said is the businesses are not really running as real businesses. They're running for some investor theme or momentum investing, or just like in 2008, everyone wanted to be in energy because nothing else was working. They inflated valuations. Companies responded to that. They did exactly what the investors wanted. And then they experience a commodity price decline, and then all the investors are like, you guys are idiots. But you know who's really smart is Amazon, who's building all these warehouses using wind power and not depreciating properly. And then that company, like Yahoo was Yahoo until there was Google, and Ask Jeeves was Ask Jeeves until there was Yahoo. And somehow we don't think that Google, which is like a revenue cloud company, or these other guys just go away like catastrophically. It's very odd to me, and I find it very paralleled to energy. But you talked about some opportunities that you think exist in energy and some investment thesis that maybe ties to all this conversation.
Yeah. And I guess just to your point, it's like the chart of the 1,001 days in the life of a Thanksgiving turkey, right? Life looks great and life is getting better and better and better, and then it's Thanksgiving. And so, you want to try to avoid those. And unfortunately, investing in oil and gas, like one might feel like the Thanksgiving turkey right now after this COVID government mandated shut-in demand shock, along with OPEC plus getting into this, price war that supposedly is ending. But, it's a kind of ironic to be in the middle of that and be kind of pointing fingers elsewhere. And I appreciate the irony of that. But, I think there is some truth to it. And I think it's important to be able to evaluate something and not just see what's happened, but what may happen and what this is similar to. And I think I agree with you in terms of this downturn feels more similar to, let's say, 2000, 2001 than it does to 2008, 2009. And that similarity matters a lot because it will affect what things look like on the back end of this. And I don't think the back end of this is like June. I think the back end of this is maybe a year or two or more in the future. And so it'll be really interesting, I think, to see how these things come out. So a couple of things that I'm doing that I found particularly interesting in kind of this bizarro world, like you were describing, where people just like bet on trends and kind of ignore like fundamentals. As a part of the oil price crash, there's been supply shock to natural gas and to natural gas liquids. And a lot of producers have already cut their rig counts and their completion crew and staff counts. So there's likely going to be less associated gas getting produced just by less activity, but then also there may be shut-ins for some amount of time. And when you compare that to the amount of demand destruction associated with the economy slowing down for natural gas, the two are out of balance in favor of natural gas. And if you look at these natural gas equities, many of them are at 5-year lows or they're near them, right? So they're up 300%, but they're still down, 90 or 95% from where they were in 2014 or 2016 or whatever. So that to me is interesting. And, I don't really want to talk about specific companies or whatever, like in terms of like what I own or like or whatever, but like, I think just as a theme, it's interesting to see a whole sector painted in one brush and watch this revaluation that's starting to happen in natural gas producers without very much attention being paid to it, without very many people talking about it, and where there's still these like giant opportunities for revaluation, not my longer term oil thesis of, hey, this just needs to be up, but like things where it's actually up already and where they're actually already making more money and where they can lock in pretty high prices with pretty high actual profits relative to price expectations on stocks that are still very, very low.
It's funny that you talk about that because again, and I know that you're a very data-driven person and very analytical, and you can hear it in the way that you look at problems. And, March 7th, basically the day Saudi said, because forget Russia. Russia mattered, but what really mattered was Saudi and their response. And that day I said to my family, oil, just because they happened to be in my house. So I would have told anybody if they'd been in my house, but they just happened to be there. And I was like, this is the end of oil investment in the US. To your point of drilling and completions, because it's big capital. So there's some nuance with water floods and CO2, and we can talk about the economics, but it was like, this is the end of oil investment because now Saudi or Russia can snap their finger and move commodity price $20, $30, $40 and destroy any hope of profitability. And that the winner in this is natural gas, because the net outcome, and I said this March 7th, was we will drop rigs to less than 200. We will drop frac spreads to less than 100. I think they both go lower, and frac spreads probably hit 50 today. But that the winner is, with 4 million barrels a day of decline, that's 20 BCF a day of gas. That comes out of the market, gas trades up. But that ties to my overall thesis and your points of what's Concho's valuation. And EOG and Concho, even going into this, every speech that I ever gave live, I said 95% of oil and gas companies on both sides are 50 to 100% overvalued, which is why you can't buy them. And because I was a long player, not a short player like BRV on Twitter, I went long the relative value names that I thought would win relatively in a $60 world, instead of just shorting the entire sector, which clearly that's the safer bet. And I tie all this back to your natural gas thing is, I agree with you. We're looking at a $2.50 or $3 world because the oil declines. And it won't be as economic in a recession to invest in solar and wind, and this biomass conversation that Michael Moore has started is going to have ramifications for people thinking about pollution and the hypocrisy. So natural gas is a winner, but all the companies are so overvalued, even in a 250 flat world for the next 10 years, and have so much firm transport and own all the good rock. It's very hard to find a public company that has a fundamental value thesis that isn't just a relative play. Like Antero, I wrote a post on them, $1.94 an MCF in firm and ad valorem before an MCF is even drilled. And they have to grow into $250 million a year of firm transport liability that they have for the foreseeable future. So Antero's up 150 or whatever percent on the stock, but at the core, I still think that they're massively overvalued. So how do you make a play as a public company investor that isn't, again, a massive short of the industry and a relative long of a player? Which I know was a lot in there, but that's the nuance I see as an investor in public entities in oil and gas that makes it really hard to win, which is why they were leaving the sector in the first place over the last 4 years.
Yeah. So first of all, everyone leaving the sector is great for the future value of producing assets. So the less popular the industry gets, the better the prospects are, I believe, as a public equity investor that's value oriented, because the risk to value, and there's a particular framework that you're describing that one of my friends, I think, came up with called long shorts, where instead of shorting stocks, which is highly risky for a lot of reasons, you have to maintain borrow, you have to pay a cost of borrow, you tend to be shorter term oriented because of the nature of it, because of the cost of borrow and the risk of losing it. And then your maximum return, if you keep your position at the same size in terms of number of shares, is 100%, whereas on the long side, you can earn many times that in theory if you're right. So what you're describing, and I like to describe it like this, is this concept of long shorts. So you're long something as a way of betting against some other thing, and your thing could potentially go up many, many times. So in theory, it can do better. Obviously, any investment has lots of risks and can kind of have a lot of different things associated with it. I'll pick on Antero for a second. So I actually own some Antero right now. I bought it at 75 cents. Again, like I've lost money on other stuff, so this isn't like some ringing endorsement of my track record. But right. The bet there was, one, they were hedged actually at higher prices than the current price for natural gas, which is important because the current price for natural gas still isn't that good. I think we're at like 190 or something last I checked.
Yeah.
And so almost everyone loses money producing gas at 190. But people don't lose money producing gas at $3, which you can hedge a decent amount of your production into for some portion of the next year. And so I like the guys that are more hedged, especially for the shorter term. And I like that they're pretty misunderstood. I think there was just this kind of conventional idea that Antero was going bankrupt. And yeah, they have all kinds of conflicts where you have Antero midstream and Antero upstream, and like the same people manage both. And there's these weird cost structures. And yeah, there's like lots of complexity. But if you actually look a little bit closer than what you're describing, some of that $1.90 or $2 or whatever cost structure you were describing actually comes back to the upstream through their ownership of the midstream. And when people value the upstream company, they tend not to include this value of the midstream because it is circular to some extent. So part of the bet there, and again, I made this a very small position, but I did think it was misunderstood, particularly because of the hedges, where they were kind of like it was going to be a 2021 credit event if it was going to be a credit event at all. And with gas strip moving up, it got more obvious. And also, this was after EQT had already doubled and after some other stuff was happening. So it was more of a bet against the negative sentiment and a misunderstanding of the company. But there's this like circular thing that happens for Antero the other direction, where everyone's shorting the stock because, hey, the upstream and midstream are both going bankrupt. Therefore, there's a great short. It doesn't matter what the price is, let's sell it. Well, when things start getting better and the natural gas strip starts going up for them, they have this circularity to the positive, whereas Antero midstream started trading up a lot, and then the upstream started trading up, and then the midstream started trading up more. There's a circularity where, because they own so much of the midstream and because so much of that cost structure is actually just money cycling from the upstream to the midstream back to the upstream through the dividends paid by the midstream. And maybe I lost you there, but
no, I totally follow. Yeah.
So there was some like embedded value there, and then they were trading at a huge discount. If you netted down their actual costs, net of kind of this circular midstream, whatever, they were trading at a pretty large discount to the EQTs of the world, even though arguably the assets were somewhat comparable. And maybe it's more comparable to Range Resources, but they hadn't yet sold a royalty on their assets like Range had done. And if you looked at it pro forma for a bad royalty deal, it was valued cheaper than range. And for a good royalty deal, it was valued much cheaper. So there's kind of a few different dynamics there. And again, this isn't a recommendation of Antero. I might go sell my stock tomorrow. I've already sold some of it. But I think there's some complexity with these companies. I don't know that I answered your question, though.
No, you did.
But
I think also, and this was the same as we had an episode with Breezy Carlson and talked about legal force majeure declarations and how that plays into lease constructions and shut-ins. And the point is there is no easy answer, and that everything is a call on a thing. And so, on the one hand, similar to Amazon, one could look at Antero and say, well, this is a company that owns two different entities that it spun out for financial reasons, and it has this inside baseball thing going with fees that aren't fees, that does this. And so that should scare me off. But then the other thing that you pointed to is everything is a relative value play. And so if you have to have a cash allocation to something, then you're going to own it, and you're going to own it until the thesis blows up. And so what I find interesting about right now in the stock market in general is there's a lot of reasons you have to buy Amazon, or you have to buy Google, or you have to buy Apple, because people need to be invested. And that thesis holds water until it doesn't. And then when it doesn't, it just epically collapses, as we saw in 2000, as we saw with the banks in 2008, as we saw with mortgages, as we saw with the savings and loan crisis in the 90s. As we've seen in every major event, it's one large catalyst that changes it. And if you're positioned well for it and you make the right call and you do it once, you should get super, super rich to make up for the 30 or 40 calls that you made wrong during your career. Because things don't come together, right? Is that a fair sort of characterization as the Antero nuance?
Yeah, to some extent, but there was some fundamental analysis. It's not like I ignored the fundamentals of the business and just made kind of a relative value trade. The fundamentals for Antero were, if you either valued the midstream based on a intrinsic value of what they could likely sell their ownership of the midstream over time, based on a combination of the public market valuation for it along with the likely long-term cash flows from that, or you added back the cash that they were putting out to the midstream for their proportionate ownership of the midstream, either way, and then you looked at the discounted cash flows, there was some significant embedded value plus some embedded optionality in the stock at 75 cents. Like, it was just wrong. And I think to some extent, the momentum and inertia effect you're describing had happened for Antero in the wrong direction, right? In the negative direction for them, where people were short the stock, kind of had this idea, hey, this is a thing that is going bankrupt. And there was a rumor about them like restructuring a few months ago, and they publicly said, no, we are not doing that. At the same time that Callan said they were going to do it, at the same time Whiting was doing it, and so on. These guys said, no, we're not. We don't need to. We're hedged. We're fine. And so it's kind of interesting, even though they said that, right? And like, they could make money by restructuring something like that, right? Management teams apparently can get 8% of a pro forma company, which is horrific and a whole other set of problems. But like, they could do okay on a restructuring personally, and they still were pushing back on it. They're like, we don't need it. It doesn't make sense. We're fine. Here's why. And like, it didn't matter that they said that, in the same way as it doesn't really matter that you or I might say, hey, Amazon or Tesla or whatever doesn't make a lot of sense as a fundamental investment. It doesn't matter until it does. So I guess I'll talk about one other idea that's really similar to natural gas.
Yeah.
That's also maybe even more controversial. And
we love controversy on the show. So
yeah, and it's like, I kind of like being called an idiot about something, because I'm a lot of things and I make lots of mistakes, but I'm pretty sure I'm not an idiot. So when I start getting called an idiot for things, I get more excited about them. So this is something that I've been called an idiot actually multiple times, even in the last week or so on. So product tankers. So the only space that's invested worse than upstream E&P and oil services in terms of just gross malinvestment and shocking underperformance relative to the market and everything else is the tanker space. And product tankers in particular, generally companies are run by people that have either been in jail, so it's kind of like the gold mining space, or like should have been in jail. So terrible capital allocation, terrible governance, just a whole mess. But there's kind of this combination of factors where after 8 years of material underinvestment in the space in terms of replacing old tankers, which by the way, all go away after I think it's like 15 years and you basically can't economically run a tanker anymore.
And we're talking about
especially
these big ships that have 160 million barrels of crude in them right now.
That are storing it, but I prefer the ones that are holding jet fuel and gasoline rather than the ones that are holding crude. For a lot of reasons. One, the contango in jet fuel and gasoline is way higher for obvious reasons. No one's flying right now, but refineries still produce jet fuel. And so you're in this really bizarro world where future jet fuel is very valuable because it's always been valuable, but spot jet fuel is basically negative or near negative. And so you have this giant incentive to store the stuff. Sure, it doesn't stay good for very long, but you can just run it back through a refinery and it's good again after a very low cost. But there's all these other things that are going on too for that business, right? There's been this underinvestment for many, many years. The average life of these fleets is very old, and many of the public equities are very highly valued, even though they have really old fleets. But if you look through and do the work, which no one's doing because everyone hates the space, and basically the best trade has been to short it for the last 8 years. And again, there's all these things to not like about it. But if you do the work and you find the guys that don't have the oldest fleets, and you look at how much money they're making, some of these, there's this one that's like around a $20 stock, and they're making somewhere between 10 and 15 cents per share per day in free cash flow. And it's like the most undervalued thing I've ever seen, possibly ever. Not forget liquidation value, like actual like cash generation. And so people hate it because they say, oh, contango is going to go away. Well, not so much on products. The contango should last for longer. But in addition to that, IMO 2020 happened, and so there's more need for certain kinds of fuel and less need for other fuel.
And for IMO, just to explain to people, that's the change in the fuel, including sulfur, right? It's a new composition for those who don't know the IMO 2020 regulations.
Yeah, sorry. So it changed what you need to use to power your ship. So you either need to put scrubbers in to reduce the pollution emitted by ships, or you need to use a different kind of fuel, which some of the fuel that's being used needs to be carried by product tankers too. So it created additional demand. And then I think the big thing people are missing on this is the longer the shut-ins and stay-at-homes and economic disruptions last, the more need there's going to be to move products, refined products from one place to another. So everyone's tracking oil and saying, oh, okay, well, oil inventories might be peaking or closer to peaking, and so the contango trade might go away to some extent, and maybe the transport trade on oil goes away to some extent. But on the product side, contango likely lasts for a long time because there are these big disruptions and certain products will need to be stored, and it's economic to pay a lot to store them. But there's also these giant disruptions around the world where you see, some refineries still running pretty hard on the Gulf Coast here. And they need to ship some of that jet fuel to Asia where maybe there are more flights still happening. And so you see more competition, and that's going to happen probably for a while. And then maybe you end up shipping jet fuel from Europe to the US or from the US to wherever. There's bigger disruptions that have happened that should likely propel earnings for a while. But then you get back to kind of the base structure of the industry, which is there's been underinvestment for so long because everyone hates tankers because it's the only industry that's worse than oil and gas upstream. So because it's so hated and the cost to get a new boat is so high relative to the cost of capital for these businesses, and because there's been so much malinvestment, there's kind of this runway where it's going to be hard for rates to go down too much for too long because there's just not enough boats. There's going to be boats getting decommissioned and salvaged every year. So it's kind of structurally mispriced. And one other really interesting thing about it is when you look at the oil majors and you look at some of these other guys that are supposed to be doing really well, and I guess this is timely because Exxon and Chevron just reported, Shell cut their dividend. And these guys are really having abysmal quarters and their businesses are breaking.
And it's not even Q2. They're reporting something that they got to run 60 of the 90 days in the quarter were normal. And you could even argue that 80 of the 90 days in the quarter were normal with the exception of a small hint of oil price falling because of demand destruction in China. So Q1 doesn't even look anything like what Q2 is going to look like.
Right. So Rockefeller is essentially spinning in his grave, right? Because there was this idea of integration in the supermajor business model and how he positioned, and the kind of inertia and mismanagement, it extended up to the majors too for a while. Maybe it extended to the majors and then extended back down at some point to the independents and kind of has pervaded the industry. I'm not sure what the direction is, but there's certainly been material malinvestment by the majors and super majors, including now in, going and overpaying for land in the Permian and drilling wells when the price of oil is negative or very low. And they messed up and they didn't maintain their integration. The whole point was they were supposed to capture the whole value chain. And if one part lost money, the other part would make money, right? Like you own the production and you own the refineries. And when oil's high, your refineries make little money, but your production makes a lot of money, and vice versa. You're supposed to own the whole thing. Maybe you don't own the services, but you own kind of that whole value chain. Maybe both refining and production suck, but like midstream makes a lot of money. The idea was that there was always something. And so they're light on natural gas, which should do quite well on the backside of this. And they got into it at the wrong part, right? As gas was collapsing, right? Exxon buying XTO 10 years ago, 11 years ago, Chevron buying Atlas, even bigger disaster. But then
BP buying Shell buying BG.
Yeah, right. Shell buying BG, that's an even bigger. That's bigger like this disaster. Bet on LNG at the very worst moment, right? These guys come in, or like Encana, and this is like not exactly the same, but
Atheon
buying Athlon. Yeah, they bought Athlon. They bought them at the price that they had agreed to when oil was at 100, and oil was at like 40 when they closed, and they had, it was a material adverse change. They could have not done the deal, and they just did it anyway and destroyed giant amounts of value in that. But anyway, the oil majors, like, they've done these things, but what they haven't done is maintained their appropriate amount of integration across the value chain. And I think it's opened up this opportunity on the public equity side to come in and pick off really specific ones, whether it's product tankers, whether it's natural gas producers, whether it's low decline oil, to benefit even, like you said, it's been really painful to be long short, right? Owning anything in this space has been painful, but over time, over a sufficient amount of time, and over this cycle, especially coming into the next part of the cycle, I think that sort of approach should be rewarded.
So, for what it's worth, obviously not an idiot. And I hope for listeners, this has been a super deep technical, and I don't mean like we're going super deep, but the depth of your knowledge, Josh, in terms of how you make an investment thesis and the amount of thinking that goes into why you're positioning here or there, or what the subtext is, what the historical concept is. And as you said, you've had all of the same logic for your entire career, and sometimes you're right and sometimes you're wrong, and until it actually occurs, like, you don't know why you failed until the thing happened that failed. And I look back on, the concept of a long short strategy very clearly in hindsight. The right answer for me, given that I had been telling everyone and their dog that you couldn't own Concho because it was only worth 28 a share at best in a $60 world, but you could own CDEV because it was worth $5 a share, so there was a relative value play. Very clearly, in a $20 world, I should have been short everything. In a $100 world, I could have even gone long short, and I would have done relatively better, and I only know that in hindsight. But my I guess, to summarize, so we don't become a Joe Rogan 3.5-hour podcast, even though I could talk to you for the rest of the day. I mean, how much of this is actually the issue with the financial markets and the things that we're seeing is because super smart people like you are not running these companies. We have a whole bunch of career politicians who have stayed in large corporations and were able to manage the politics over a 30 or 35 year period. And some are superstars and some are not, but most aren't like Elon Musk or Steve Jobs or Bill Gates, who started their own company and ran the whole company until they left. So like, that company was them. But we have all these, the city of New York is a whole bunch of smart, analytical, young, hardworking, greedy, hungry motherfuckers that are making investment calls on all of this and driving stocks here or shorting this or moving this or doing this. But the business teams that are running the actual business don't have anywhere near the level of insight, quite frankly, that y'all have. Do you think that has exacerbated these 2008, 2000, 2020, where we have these macro collapses because everyone has built these nuanced financial structures with brilliant people making massive levered bets in order for them to become billionaires, like Einhorn, like Ackman, like Dalio, etc. Well, what do you say to that as in close?
Yeah, I mean, so a few things. So one, I tend to not build financial models on companies I invest in. If I need to build a financial model, it's too complicated and it's too overvalued, or too likely to go bankrupt or whatever. And I'd say, like, when I started, when we launched Bison in 2015, the investment fund that I'm managing, or the investment company I'm managing, and portfolio manager for, got tons of pushback for not building financial models and for not being a reserve engineer or not having geologists on staff or whatever, and got to see people allocate to funds that kind of looked kind of sexier, or that had kind of these like buckets that they were trying to check, that the guys in New York or whatever were telling them to check, and got to see just massive capital destruction. I mean, these guys, like, some of these things, I'll pick on Alta Mesa because I talked about it publicly. I mean, this was just like total crap. Like beyond words.
Yeah.
But they had the boxes checked, and so people kind of blindly put in money at giant incentive fees and giant management fees and whatever to fund this thing that at the outset was fairly obviously not a good idea. And when asked, I gave the honest truth, which was, hey, this thing, it doesn't matter what the model is saying, this will lose money. And this is a not value investment. This is being misrepresented. And it was. And, it ended up as a zero, which was astonishing.
It does that $3 billion loss in like 14 months. Roughly.
$4 billion, I believe, between Riverstone and another private equity fund and large endowments and foundations and all kinds of weird trading activity and all kinds of weird insider stuff. And the chairman getting a doctorate at Harvard, studying Enron and corporate management and responsibility, while simultaneously kind of repeating some of the stuff that had happened there in terms of rapid blow up and capital destruction. So yeah, I think a lot of it is about what the climate looks like and what will happen when it does. It does seem to inevitably change. And when I started my career in investments professionally, I was with this family office and got to meet a lot of other asset allocators. And generally the idea within asset allocation at that time, this was on the back of the 2000 crash and the reallocation of money towards value managers and towards finding things that weren't necessarily on the run, was to avoid asset managers in New York, to avoid the kind of like hot trader, like, whatever types, and to try to find deep value and to try to find people that were like thinking about things in kind of a reasonable manner. Both on the allocation side, but then that followed through and flowed through to management teams, where if you're selecting for investment managers who are sane and longer term oriented and less trading oriented and so on, that should translate over to them investing and providing capital to people who are longer term oriented and who aren't still running frac stacks when oil's at a price where they're guaranteed to lose money despite them claiming that they're return oriented or whatever, right? So I think it's kind of like a circular thing to some extent, and it builds up, in some cases for decades, right? But you don't want to be there, I think, for that Thanksgiving turkey.
Yeah, the event. Well, and I mean, and it's funny because I know you're talking about Jim Hackett, because I worked for him when I was at Anadarko. Before I left Anadarko in 2009, he was chairman of the board at the time. But I think it was a great thing because he, as an example, I have a lot of respect for him, the person, and him, the leader, and for what he did for Anadarko way back when I worked there. So this isn't a knock or a condonement. But what's interesting was he didn't build that business. He was given credit for the Seagull rebuild going to Devon, then came in to fix Anadarko in a time very similar to now where our industry had challenges, rebuilt the culture, price overlaid with positivity, got a lot of credibility, and then a private equity fund wants to go just hand these people who used to have success billions of dollars because it looks good for endowments and it checks the box. But the people we revere the most are the people who started their company in the right industry and stayed there forever. And they've only ever had one win. Jeff Bezos, one win. Bill Gates, one win. Elon Musk, if you'd call Tesla a win, one win. But these guys, Steve Jobs, like these are guys that they were career in the thing they did, and they were only right once. And yet investors always want to give these people with a track record money. To me, I want to bet on the loser The guy that tried 10 different things, like they're gonna win. They're gonna win sometime, and it's not likely the next one. But really good points on investing, and I mean, we covered so much. I'm trying to think about how one does show notes for this, and I think it's just going to be a very deep conversation with not an idiot. So Josh, thank you so much for joining us. Are you ready for the is there going to be masks where you are? Like in
Yeah, I
terms of
mean,
going out?
I'm in Houston. It's kind of weird. There's been conflicting things. The governor said you don't need them, but it's recommended. Certain businesses, like certain grocery stores and whatever, are mandating you can't go into their store unless you're wearing a mask. And I think the city and county said you have to wear masks, but the state said you don't have to. So unclear.
Well, what's amazing to me is that Fauci said masks don't work. Then people are making masks out of, like, my son made a mask out of an old t-shirt today. So it's like the sleeve that he puts around his head. And so I know in Denver, Mayor Hancock is going to come out next week and mandate masks. So what I have for those, I have a little mask here that is ladies' underwear. And it's very clearly not N95 with the lace, but I am going to wear it because I think that we've moved so far past off science and the ridiculousness of, like, we just need to do this. So, okay, I have a mask. It'll be interesting in light of all the nuance we had over every single topic that we could have had, that there's like, but you must wear a mask. Go out, wear a mask. Don't go to the beaches because it might, but there's no nuance here, guys. There's no nuance. So until next time, I am DRW. You are listening to the Hot Take of the Day podcast. You can get all our archives on the website at www.hottakeoftheday.com. If you have topic suggestions or guest suggestions, you can always email me at drw@hottakeoftheday.com. We always appreciate you listening and getting feedback and getting all the emails. I write back. And so until next time, be safe, be good, have a great day, and bye for now.